Hello and welcome back to Core Finance. I'm joined by Connor Campbell, who is a financial analyst at Spreadex, and we're going to look at three stocks, two quite similar, one probably different from the group. We'll start off with Snapchat, and this one obviously has been IPO'd. A lot of interest in it, a lot of people negative of the stock, a lot of people positive. So here we are, coming into the last months of the year. How has Snap performed? End of term report.
Pretty damn poorly, to be honest.
Yeah.
You know, it's down 36.5% since it's sort of the first day of trading. You know, it spiked to nearly $29.50 on the, I think it was the second or third day of trading. That was in early March, and then by mid-August, it was down like less than $11.50, which is quite a long way to travel in 5 months. Since then, it's sort of solidified around the $14, $15 mark, but his figures have just been bad, basically. Oh, not bad, but it's underperformed basically on every metric possible. Back its first quarter report back in, I think it was May. Sort of electric revenue growth. I think it was up 286% to $149.6 million. Obviously, again, it's a growth stock in that regard, so those figures are sort of perhaps more flattering than they should be. But then it underperformed on daily active users, which is the key growth, and then it posted 2.2 billion in losses, which that was sort of grossly inflated by, I think it gave out 2 billion in IPO related bonuses, but still it's a pretty ugly headline figure to come out of your first quarterly report since launching on the stock market.
I mean, could we almost overlay the likes of Facebook, Twitter onto this chart? I mean, it seems like there's a common theme here, there's a common pattern. There's a lot of expectation at the start, it disappoints in continuing quarters, but then, as we've seen with Facebook and some strong numbers over the recent week, they've become a turnaround story. Could this be the case for Snap, or really?
I think that'll be really dependent on how quickly it can bring down its sort of net losses each quarter. Because I think in August it posted 430 million net losses, which was around 50 million higher than expected. Again, revenue is decelerating at quite a pace. I think it was up 286% year on year in the first quarter, up 150% in the second quarter, and heading into the third quarter this evening is meant to be up 86%. So that's a pretty sharp drop off quarter on quarter.
Do clients like this stock?
No.
Okay,
they do. You think there is room if it beats expectations. I think expectations have changed quite significantly since March. So what people are looking for from the stock has changed. So there is room for it to bounce. You know, it's fallen quite sharply since its IPO. There's room for it to bounce. However, our clients are really heavily selling it around that $15 mark. I think the key, go back to its comparisons to Facebook and Twitter. I think if you look at the difference between Facebook and Twitter, it is largely down to user growth. Facebook has remarkably managed to continue growing at an astonishing pace. You know, it crossed 2 billion users, 2 billion monthly active users for the first time this year. That's incredible. Twitter, on the other hand, has struggled. And whilst I think Twitter hovers around like the 300 million mark, maybe 350 million mark, in comparison, that's a lot lower than 2 billion. And also the pace of its growth has slowed. You know, you've seen a few quarters this year of Twitter not really growing that number at all. In terms of Snapchat tends to favour daily active users. I think percent quarter on quarter in the first quarter. That fell to 4% quarter on quarter in the second quarter. I think it's expected to add 8.5 million daily active users between the second and third quarter. That will take it to around the 180 million mark, which is sort of its infancy compared to Twitter. Having around half Twitter's numbers isn't too bad. But if that figure continues to slow, and it's trailing Twitter by 200, by around 150 million users. Plus, repeatedly, it's underperformed expectations in terms of daily active users. I think that's sort of been the death knell both times, underperforming on that key metric. The net losses and the revenue slowdown can perhaps be overlooked if you're posting really robust user growth, because then the monetization of that can come later, and sort of really pumping those numbers can come later. But if you're constantly slowing down on user growth, I think that undermines your potential to grow revenue and profit later on in your future. So I think that is why our clients have been selling around the $15 mark, because in the last 2 quarters it hasn't proven that it can hit the expected daily active user growth figures.
Okay, we'll see how they perform tonight. Moving on, Marks and Spencer's. Up or down, where we're going? Numbers due out this week.
Yeah, it's been a pretty wet and wild year for Marks and Spencer's, really. I think it was 12-month highs at the end of May, and then by the end of August, it was at 13-month lows. So that was a pretty swift drop. A lot of those losses come across June and July. That's sort of a sector-wide trend, especially in June. June was a horrible month for retail. The retail sector, you had sort of the really hot focus on inflation and falling real wages and falling retail sales and things like that. Its figures haven't been great. Full year figures in May, it saw restructuring charges hit 63.5% drop in pre-tax profit, which is ugly any way you look at it. I think like-for-like sales in the clothing division were down 3.4%, which isn't great. Even worse was a 5.9% fall in the fourth quarter. The food division was down, like-for-like was down 0.8%. Again, that is meant to be Marks and Spencer sort of saving grace. So anything approaching a 1% like-for-like drop is not good news. First quarter figures in July. Clothing and home division, again, like-for-likes were down 1.2%. Again, that's a pretty hefty improvement on the 5.9% drop in Q4, but still not great. And then again, the food division disappointed. It was only down 0.1%, but that was worse than expected. And I think the figure would have been far worse if Easter hadn't fallen when it did. The food division got a huge boost from Easter. Since then, you've had Joe Jenkins, which was Marks and Spencer's head of fashion and home, only been in the job a few months, left at the end of October. That was sort of a shock for the company. Didn't cause massive movement on its stock, but it's still, you know, they're really struggling to find something that sticks in its fashion and home. They're really struggling to attract younger customers, which is crucial to the health of the stock in the future. Because if people grow up seeing Marks and Spencer's as an old person stock, it's going to just fall out of favour as the years go by, and you've seen that in the last few years. Then, you know, with next third quarter figures last week, it saw a sharp drop. Then, just on, you know, those next figures sparked a real wave of concern in the retail sector in general. In terms of its half year figures this week, I think pre-tax profit is expected to be down 12% to 203 million. Clothing like-for-likes down 1.4%. That's not too bad. That's still around the 1.2%, 1.4% level seen in the first quarter. As long as it doesn't get towards those near 6% levels seen in the fourth quarter of last year, I think it'll be okay. Food division meant to be down 0.3%. Again, I think that'll be a source of disappointment if it can't eke out some growth. Our clients, however, they're buying around the 330 mark. I think they've been buying since it fell on Next figures last week, just because that sharp drop last week gives it a bit of room to bounce if the figures, I guess especially the clothing and home figures, are better than expected. I think, you know, investors also want to see some news on appointing a new head of the fashion and home division. If it can get an eye-catching appointment there as well, that could help it out heading into the new year.
Understood. We'll look out for that. Maybe a tie-up with Next is a story that's flying around the markets. And finally, briefly, we'll just look at Sainsbury's, obviously with their tie-up with Argos, and that's starting to feed through. But really, wage growth, retail sales, inflation, it's all the same story.
It's a similar story in a sector that is even worse than sort of the clothing sector, basically. I think CEO Mike Cooper even said with his full year figures back in May that the supermarket sector is one of the worst, if not the worst, sector to be in, which is true, but isn't necessarily what you want your CEO to be saying. It's full year figures in May they were mixed, basically. Pre-tax profit was down 8.2%. Part of that was related to the costs of buying Argos. But full year sales were up 12.7%, again, largely due to Argos. I think there was a lot of doubt when Sainsbury's bought Argos that it was a bit of a wrong-headed move, given how poorly Argos had done. But Argos has now repeatedly been Sainsbury's core strength since they bought it. Core strength. They've managed to really turn it around strongly. I think, you know, placing stores in the supermarket, improving functionality like that has paid dividends, which it has needed to do because the supermarket itself has been trailing the likes of Morrisons and Tesco, both of which Morrisons has, you know, found a nice seam of like-for-like growth. Part of that is going to be due to its weakened performance in the last few years, but David Potts has really done a turnaround job on that company. Tesco as well, it's, you know, huge, you know, the boss of that sector basically, and it has room to hold on to its growth and lower prices in a way that will damage other supermarkets. Sainsbury's, I think full year like-for-like growth was down 0.6%. That was an improvement on the 0.9% growth the year before. First quarter figures were very healthy. I think like-for-like growth was up 2.3%, and that's the best performance it's seen since 4% in 4 years. Sorry. However, it hasn't really helped its stock price. It's still slumped in the last few months, and if 2.3% like sales growth can't help your stock price. I'm not really sure what can. In terms of its half-year figures on Thursday, investors want to see a continuation of that like sales growth in the second quarter. If it can package together a nice, 2.5% like sales growth for the first half of the year, then it could bounce from its 230, 234 lows. Our clients have been buying around those levels just because I think of the strength of those first quarter figures, and just it's slumped quite badly in the last couple of months. There is room for growth on the slightest beat, basically. And with Argos backing it, the headline sales figures should be quite healthy. So it might be able to attract a few investors through that, I think.
Understood. Well, 3 stocks there that prime to maybe beat the market. If they do, they could trade up, but if they don't, downwards they go. In the meantime, Connor, thank you very much for joining us here on Core Finance.
Thanks very much.